Tax-free municipal bonds for a safer retirement, DMB. Let's face it, retirement planning in 2025 is like trying to play chess while someone keeps randomly flipping the board. You've got a Fed that can't decide if it wants to be your sugar daddy or your evil stepmother, inflation numbers that bounce like a toddler on a trampoline, and stock markets that have all the emotional stability of a reality TV reunion. So when someone whispers the phrase, tax-free income, your ears should perk up like a golden retriever hearing the word, walk. Enter, municipal bonds. Specifically, let's talk about DMB, the BNY Mellon Municipal Bond Infrastructure Fund, a closed-end fund, CEF, that offers exposure to the kind of municipal bonds that could actually help you retire without having to sell your house, your kidneys, or your soul. Wait, what's a municipal bond, and why should I care? If you're not already in the Muni bond game, let me explain it to you like you're a tired 55-year-old with a bad back and dreams of a Florida condo. Municipal bonds are essentially IOUs issued by state and local governments to fund things like roads, bridges, schools, and water systems, civilization. Here's the kicker: the interest is generally exempt from federal income tax. And if you live in the same state that issued the bond, you might be off the hook for state and local taxes too. Boom, triple tax exemption, baby. This isn't some wild, speculative growth play. This is the financial equivalent of warm oatmeal and orthopedic shoes, unsexy, yes, but reliable and comforting. If you're building a safer retirement portfolio, you want a stable base of predictable income. Tax-free income. That's where DMB comes in. DMB, the fund that buys the bonds that built America. So let's get cozy with DMB, BNY Mellon Municipal Bond Infrastructure Fund. This is a closed-end fund, not to be confused with an ETF or mutual fund. It has a fixed number of shares and can trade at a discount or premium to the net asset value, NAV. Spoiler alert, it's currently trading at a nice little discount, which we'll get into later. DMB focuses on investment-grade municipal bonds tied to infrastructure projects. Think water treatment, power grids, transportation, the stuff we all depend on but never think about until it breaks, or Flint, Michigan becomes a national headline. This isn't a scattershot bond buffet either. DMB's portfolio is curated by seasoned professionals with one goal in mind: long-term, tax-exempt income generation. And while past performance doesn't guarantee future results, insert the usual SEC disclaimer here, the track record is nothing to sneeze at. Why Munis, and why now? 3 words: interest rate cycle. We've been living in the shadow of rising interest rates for 2 years now. That's battered long-duration bonds and spooked income investors. But guess what? We're at or near the top of that cycle. The Fed has started to blink. Inflation is cooling. That soft landing? It's no longer a joke, it might actually happen. When rates stop rising, or even start falling, long-duration municipal bonds stand to gain. That's because bond prices move inversely to interest rates. If you get in before the reversal, you're locking in higher yields on quality bonds and positioning for capital appreciation. DMB has an average duration around 10 years and a yield north of 4.5% tax-free. Depending on your tax bracket, that's the equivalent of a 6 to 8% taxable yield. Let me repeat that slowly for the people in the back: a safe, 6 to 8% equivalent yield, without paying a dime in federal taxes. The tax angle, legal evasion you can brag about. Let's talk taxes, because if you're planning for retirement and not thinking about taxes, you're doing it wrong. Every dollar Uncle Sam doesn't take from you is a dollar you get to keep compounding, reinvesting, or spending on golf memberships and grandkids. A Muni fund like DMB gives you federally tax-exempt income, and sometimes it's exempt at the state level too. That's not a loophole. That's not a gimmick. That's the actual design of the U.S. tax code encouraging investors to fund public infrastructure. For a retiree in a 32% federal tax bracket, a 4.5% tax-free yield is equivalent to a 6.6% taxable bond. If you're in a high-tax state like California or New York and the fund has exposure to your state, the equivalent yield could be even higher. That's alpha you don't have to earn, it's built in. But Antonio, isn't DMB a bit boring? Let me tell you something: boring is beautiful when it comes to retirement income. Boring means you're not biting your nails every time Jerome Powell sneezes. Boring means you're not explaining to your spouse why your hot new AI ETF lost 18% this quarter. Boring pays the bills, the light bill, and the HOA fee. And here's the kicker, DMB is not that boring when you dig into the structure. It uses a modest amount of leverage, around 30%, to juice the yield. That means it borrows at short-term rates, which are currently stabilizing, and reinvests in long-term munis, generating an income spread that benefits shareholders. Yes, leverage adds risk, but in a diversified portfolio with stable credit quality and rising bond prices, it's more of a turbocharger than a ticking time bomb. The discount, buy the dollar for 90 cents. Right now, DMB trades at a 7 to 10% discount to NAV. Translation, you're buying $1 worth of municipal bonds for 90 to 93 cents. That's called a value opportunity. It's the investing version of shopping at Costco, the same quality, just in bulk and cheaper. Over time, that discount could narrow, giving you capital gains on top of the tax-free income. That's called total return, and it's a beautiful thing in retirement portfolios. Want more spice? The fund pays monthly dividends. That's right, not quarterly, monthly, like Social Security, but with fewer politics and no awkward collar adjustments. Risks? Sure, but let's be real, no investment is perfect. Here are the real-world risks you need to consider with DMB. Interest rate risk. If rates spike again, bond prices fall. But if you're holding for income, and rates are stabilizing or falling, this is less of a worry. Credit risk. Municipalities can default, looking at you, Detroit and Puerto Rico, but DMB is heavy on investment-grade issues. Leverage risk. Leverage magnifies gains and losses. But this isn't a YOLO Reddit meme stock, it's a professionally managed municipal bond fund. Liquidity risk. As a CEF, market price can diverge from NAV. But that discount can also be your opportunity. Policy risk. If the federal government ever decides to tax muni bond interest, we riot, or at least write strongly worded letters. Who should consider DMB? Let's make a little checklist. You're in a high tax bracket. You're nearing retirement or already retired. You want steady, tax-free income. You're allergic to market volatility. You love discounts and monthly paychecks. You believe America will keep building roads, schools, and power plants. If you're nodding your head, DMB deserves a look. Maybe even a second look. How to use it in your portfolio. Don't put all your eggs in one muni bond basket. But DMB can play a strong supporting role in a barbell strategy retirement portfolio. On one side, you hold safe, short-term treasuries or CDs for capital preservation. On the other, you hold longer-term, higher-yielding assets like DMB for income and modest growth. Add in a few dividend stocks or REITs for inflation protection and you've got a diversified income-generating machine. Think of DMB as your steady, tax-efficient engine, always chugging along, rain or shine. The bottom line, DMB isn't sexy, but it's solid. There's a reason Warren Buffett's favorite holding period is forever. Because the real magic happens when you hold high-quality assets and let time do its thing. DMB isn't going to moonshot. It's not going to be a meme stock. You're not going to brag about it at parties, unless it's a party full of CPAs and retirees. But it's the kind of investment that quietly builds wealth, month after month, while letting you sleep at night. And let's be honest, in retirement, sleep matters more than hype. Safety matters more than sizzle. Income matters more than speculation. If you're looking to retire smarter, not louder, tax-free municipal bond funds like DMB might just be the financial equivalent of noise-canceling headphones, quiet, consistent, and downright beautiful. Author's note: this is not financial advice. I'm not your CPA, your advisor, or your long-lost uncle from Boca Raton. But I am someone who thinks tax-free income and boring municipal bonds deserve way more love than they get. Do your due diligence, know your risk tolerance, and remember, safety doesn't mean sacrificing returns, not if you invest like you've got some damn sense.